A big fear of pre-retirees or baby boomers is running out of money in retirement. Now, you probably have heard investment diversification, having your money diversify with your investments, but you might not have heard of tax diversification. Having the right tax diversification can allow your money to last longer in retirement, that allows you to spend more and live a long and happy retirement.
Paying less in taxes sounds intriguing, doesn't it? Tax diversification might not sound like a very exciting topic or just like tax planning in general. I know many people that we talk to, or in just in general, pre-retirees or even someone in their 30s, tax preparation, like filing your taxes, is something you're not looking forward to. So you kind of just push it off to the very last minute. But if tax diversification is done correctly over a period of time, over your lifetime, it can significantly help you pay less taxes. For most people, just think about someone who has seven figures in like an IRA, tax-deferred 401k. You're talking 6 to 7 figures in federal taxes that you could potentially save on over your lifetime. So one of the bigger things is we try to like encourage people on, to educate them on, is like getting away from the philosophy of saying like, hey, how do I save the most on taxes this year? And a lot of times when I give people, the solution to that potential problem, they don't like the answer. So how do I save the most in taxes this year is, hey, I make 200 grand a year working at T-Mobile Corporation. Call your employer and voluntarily cut your pay down by $100,000. So you're going to cut your pay in half. That will help you save taxes, make less money, show less wages, pull less money out from your investments. If you're retired, you won't pay as many taxes. If you're working, you're pre-retiree, max out your traditional 401k, get that deduction to bring your tax bill down. Max out your traditional IRAs, max out HSA. So really you're showing like barely any income and paying literally almost no taxes, but like at the end of the day, you can't live your lifestyle. What we're trying to shift the focus to in this show and the people that we talk to and help is, how do I set myself up to pay the lowest tax over my lifetime? And once we can understand that like tax planning and tax diversification is a lifetime game, we just try to teach you and educate you that you shouldn't be like short-sighted when it comes to tax strategy. Specifically, like at Mocan Wealth, our goal is to simplify tax planning for our clients. And in return, they can create more value in their retirement plan by spending more, paying less in taxes, keeping more of Social Security, and really like leaving more behind after they're gone that's tax friendly.
Okay. So to start off this conversation about tax diversification, we're not just going to talk about taxes, like Kyle just said, over 1 year or 2 years. We're going to talk about controlling your taxes over your lifetime. From a tax planning standpoint, we want to look at where your money is and how it's spread out. Of course, having all your money in a Roth, already taxes paid, and just having all your money in a Roth is ideal, but for most people, that's not attainable. So the goal is, how can we spread out this money evenly across different tax buckets to have the best distribution on our money from a tax planning perspective? And like I just mentioned, the tax buckets, let's just go over a review of what those are. So we have 3 tax buckets. Tax bucket number 1 is the non-qualified bucket. This is your taxable accounts. Bucket number 2 is your tax-deferred bucket. This is tax-deferred money. And the third and final bucket is the tax-exempt or the tax-free bucket.
Those are the 3 tax buckets. And let's take a step back. Basically, someone between like 50 and 64. It's pretty common if you're if you're listening or watching, you're like, okay, I get it. There's 3 different types of buckets. Most of my money is saved in tax-deferred accounts. So tax-deferred accounts, you're basically taking the tax break now, pushing it out to the tax-deferred bucket. That's great. That's probably maybe has been the best plan since you started working, since you started saving, going up the mountain in accumulation. But now what we're doing is having this discussion on tax diversification that say, hey, investment diversification is what I've been focused on, but tax diversification really has passed all these major tests of, bear markets, rising taxes, additional expenses in the distribution phase. So I want people to understand, like, heavy tax deferred is great, but moving forward over the next 2, 3, 4, 5, 6, 7, 8, 9, 10 years, planning out your retirement, where should we start shifting money to as far as like cash flow and savings? Does it make sense to start shifting money to other tax buckets?
So to help you understand, again, a little bit more about these tax buckets, when I say non-qualified or taxable tax bucket, what that means is accounts like savings accounts, brokerage accounts, any money that is taxable in those types of accounts. The next bucket, like Kyle just mentioned, is tax deferred. This would be like a traditional IRA, a pension, a 401k, a 403b. This is money that is, when you pull it out, when you distribute it from these accounts, that is when you are taxed. So you didn't pay the taxes when you're putting the money in, maybe from your employer plan or what it may be. And then when it comes taking that money out, that is when the taxes are paid. So that is tax deferred. And the final bucket is tax exempt or tax free. This is usually a Roth account. So your Roth 401ks, your Roth IRAs. This is when you pay the taxes when you contribute that money. The money inside of that account grows tax-free, and then when you withdraw it from that account, you don't pay taxes on it. So tax exempt or tax-free, you pay taxes now. When it comes time to withdraw, you do not pay any more taxes.
Yes, and like again, today we're talking about tax. And yes, you have to have diversified pie charts. Everybody has diversified pie charts. Everyone's accumulating, writing out stock markets. But now we kind of have to start shifting the focus on distribution. When we're taking this money out, how many shares do we have to sell to get our net income? How does it impact our Social Security? Where is it showing up on our tax return? And how impactful is that to our marginal and effective and average tax rate? So again, non-qualified taxable accounts, this is basically you're putting that money in after tax, post-tax, and now the growth could be taxable. Again, how is this growth or dividends or gains or CD interest? How is this showing up on your tax return? How is it taxed? And more importantly, will it make your Social Security potentially more taxable? Again, the answer is yes, depending on however it's showing up on non-qualified. That income, like qualified dividends, CD interests, anything like that is part of provisional income, which we've talked about in a past podcast. Is it will make your Social Security like more taxable in exchange, and it's going to raise your federal tax rates. So that's something to consider from tax diversification. Tax deferred, again, this is where most of you have your money saved. This is where a bulk of your money will be in retirement. This is where a lot of your withdrawals will show up. In retirement, understand that's going to show up every single year on your tax form, federal tax form, as a IRA distribution. What's this annual amount? Just keep in mind, for most of you, it's probably going to be in your best interest to keep a majority of it here. Questions you have to ask yourself is like, okay, what happens when tax rates go up? What happens when stock market goes down? Well, if tax rates go up, you're going to have to sell more shares just to get your net income that you need. When the stock market goes down, you have to sell more shares just to get that same amount of net income. So again, you're selling more shares at a loss while you're not really contributing anymore. You're selling, you're taking money out. And then one of the third things to keep in mind is tax deferred money is taken out, shows up on your tax return, again, from a tax diversification perspective. The downside is it's part of this provisional income. It will make your Social Security more taxable. So, depending on how you do it and how much you're taking out, it can make your Social Security potentially worth less. And then that last bucket is the tax-free, the tax-exempt, whatever you want to call it. For most of you, you're going to just basically assume like Roth IRAs. You pay tax up front. If you did a contribution or a Roth conversion, it grows tax-free. You get to spend it tax-free. It's not going to show up on your tax return. And I think one of the key points is it's not part of the provisional income, so it will not make your Social Security more taxable. And by true tax diversification means you either have money in tax deferred and tax free as a Roth, or you do have money in like non-qualified tax deferred and tax exempt, just like true tax diversification. And you can kind of control like your tax returns of what's pulling out where. If tax rates go up, you just have more control. As the expenses come up in retirement, you can say, hey, let's pull from here. So again, that just kind of summarizes those three buckets.
So when you're in the accumulation stage of your investments and your total assets, it looks a little bit different than when you're in your distribution phase of retirement, right? So your income and your cash flow can change drastically when you're in that distribution phase. So a lot of our clients, they don't just have a static withdrawal rate from their portfolio, especially early on in retirement. Maybe they want to spend more, go on vacation, enjoy their money a little bit. So they have not as much static in their distribution amounts. And that allows us to have different types of tax planning that helps them spend more of their money that they have saved up.
Yeah, as a pre-retiree, whether you're 15 years out, 1 year out, already retired, one of the most impactful things you can do as a plan is obviously when you build a plan out, you're forecasting, you're making assumptions, and really like how can we check off as many boxes as possible? And like one of the most impactful strategies that I've seen and what we've implemented and have done for our clients are Roth conversions, taking money from that middle bucket, that tax deferred, and paying the tax bill and moving it over to the Roth to let that money grow tax free. Sometimes it's going to take 2, 3, 4, 5, 6, 7, 8 years to get this done. But what's the most impactful is like seeing how tax free income in the future can come in to be spent and how impactful it is on your effective average tax rates, lowering your required minimum distributions, allowing you to keep more of your Social Security. And really, from our client's perspective, is like showing you how to spend more in your early years, maybe your first 5 years, maybe your first 10 years, depending on what age you retire. And it really kind of shows you how you can have more control. The best thing about tax planning, in my opinion, is it allows you to take control of your tax bills, because you're basically saying, hey, I'll do this and control this versus letting, hey, this next 30 years, a stroke of a pen, something happens. Oh my God, what are we going to do? So again, if you like the idea of taking control and understanding the pros and the cons and the math, I would say Roth conversions is one of the most important to your income and cash flow early in retirement and even later on. And then also like tax gain and tax loss harvesting. In that first bucket, we talked about the taxable brokerage accounts. So making sure you're not showing like excess capital gains or you're showing like excess IRA distributions, and now it's making your capital gains more taxable. So making sure you incorporate like tax gain and tax loss harvesting throughout the year to take advantage of your situation.
So as you're approaching retirement, maybe you're 50, 55 years old, retirement's coming in the near future, some things that you can do to help with your tax diversification potentially problem that you might have is maxing out your Roth IRA in the private sector, or in the 401k realm, you can max out or start contributing to a Roth 401k. This will allow you to shift that money from the tax-deferred side, that's that new money coming in, and putting it into the tax-free side. This will also help with the future RMDs that will come down the road when they start to kick in. Lower that RMD amount because you're taking money today and putting it into the tax-free bucket of your tax diversification to allow you to have that tax diversification that you're looking for between the Roth side of things, the Roth IRA and the Roth 401k.
Why tax diversification when you are retired? Let's take a look at some like tricky aspects of when to potentially like take your Social Security. Like you can run 500 to 600 different scenarios, iterations of like when to take your Social Security and all these break-even points and life expectancies. But you really need to dial in with your advisor and your CPA on when you're going to start claiming your Social Security. Social Security is not about when you take it, it's about how you take it with all of your assets coming in and all the planning that you've put into place to determine how much of this Social Security you're going to keep. Because the Social Security strategy, when you decide to claim and how you decide to claim as a single or married household, it is going to affect your long-term planning as far as how much money you can move out of tax-deferred to Roths and how much money you can spend early in retirement, and then how your beneficiaries are going to get your money. So again, you have to understand like what is provisional income. I would highly suggest going back to our provisional income Social Security show and podcast episode to kind of figure out, like what are the ins and outs of that. And then last, we just want to talk about this ticking tax time bomb and really how to diffuse it. Tax diversification is pretty simple. You have to be honest, like raise your hand. Hey, think of federal tax rates in 2024. There's a lot of politics and stuff going on right now. But let's just say, okay, let's not assume like who wins the election, but let's just say over the next 10 years, do you honestly believe federal tax rates will be higher or lower? Or even over the next 30 years? I would just say, hey, over 30 years, tax rates will go up and tax rates will go down. And now let's just talking about this sleeping giant, the ticking tax time bomb, national debt. How are we going to diffuse a ticking tax time bomb, which is potentially your retirement savings that have not been taxed? And the best way to do that is kind of like look at what your required minimum distributions are going to be in the future. Are your required minimum distributions going to bump you up into a higher tax bracket at age 73 or 72, whatever the law say they will be at that time? Is this RMD going to bump you up into a higher tax bracket and make your Social Security more taxable? Because we don't estimate, hey, at 73 of my RMD is $37,000 a year or $63,000 a year. But in 4 years after that, it's now over $100,000 a year. And now my effective tax rate is way higher. So basically, tax diversification allows you to take a holistic approach, look at the next 30 years, your lifetime tax bill, and say, okay, if I don't do anything, my tax bill is going to be up here. Does it make sense to raise it up now in exchange to lower it long term? And that's why tax diversification is super important, why it matters. is because, yes, if you do live a long life, you can lower your tax bill by 6 to 7 figures. It will allow you to potentially take your Social Security earlier and not wait till 70 and keep more over your lifetime. It will allow you to have tax-free income coming in the future. So if tax rates do go up, and more importantly, it will allow you, if you're married, to leave your surviving spouse with some tax-free income and your beneficiaries with tax-free assets to live on. So that's really what we're going to sum up today is like, do you have questions about tax diversification? If so, I would basically end the show with these action items. One, if you're local in the Kansas City area, come to our one of our Retire Ready Academy retirement masterclasses. Go to retirereadyacademy.org and sign up, or go on to our Mocan Wealth website and schedule a discovery meeting to potentially see if you're a right fit for our financial planning and retirement investment strategies.
So just to recap, we talked today about tax diversification, why it's important, how you can spread out your tax diversification with multiple different tax buckets, and why tax diversification is important for your retirement spending. Like Kyle just said, if you're interested in learning more about those things he just talked about, there'll be links down in the show notes below. But thank you all for listening, and we'll see you in the next episode.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. The word retirement shouldn't scare you. Our passion is to be here to help you navigate every step of the way. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon. But in the meantime, for more education and information, hit up retirereadyacademy.org. And if you're ready to start your retirement planning today, go to our website at mocanwealth.com. Mocan Wealth Management is a registered investment advisor with the state of Kansas and Missouri and may only transact business with residents of those states or residents of other states where otherwise legally permitted, subject to exemption or exclusion from registration requirements. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services.